Fixed deposits are giving 6 to 7%. Debt mutual funds are giving 6 to 8%. But what if I told you there's a segment quietly delivering 11 to 15% yields with structured downside protection? Today we're going to talk about private credit, one of the fastest growing asset classes globally, and now increasingly relevant for Indian investors. And more importantly, should you consider it? At Duroc, we focus on intelligent capital allocation across equity, debt, alternatives, and structured strategies. Today, let's decode private credit in a simple but practical way. Private credit simply means lending money directly to companies outside traditional banks through structured investment vehicles. Instead of depositing money in a bank, you become part of a structured pool that lends to mid-sized corporates, real estate developers, infrastructure players, growth stage companies, and in return, you earn fixed, contractually agreed returns. Think of it as corporate lending, but through an investment platform. Globally, private credit has crossed $1.5 trillion AUM. Why? Because banks have tightened lending norms. Basel regulations restrict risk-taking. Mid-sized companies still need capital. Investors want higher-yield alternatives. In India specifically, real estate funding gap, NBFC liquidity tightening, growing alternative investment ecosystem. This creates opportunity. And where there is capital gap, yield follows. Private credit typically offers 11% to 15% IRR, sometimes higher depending on structure. Fixed coupon payouts, monthly/quarterly. Additional upside in structured deals. But here is the important part. These are usually secured loans, backed by collateral, property/receivables, cash flows, structured with seniority protection. Unlike equity, you are not betting on growth. You are betting on repayment capacity. This is not for emergency fund, short-term liquidity, first-time investors. This is for HNIs, business owners with surplus liquidity, investors allocating 10 to 20% to alternatives, investors seeking predictable yield beyond debt funds. At Duroc, we usually position it as a satellite allocation in a well-diversified portfolio. Let's be very clear. This is not risk-free. Major risks include credit default risk, illiquidity, lock-in 2 to 4 years typically, concentration risk, execution risk in real estate deals, which is why manager selection is critical. Due diligence matters, legal structure matters, underwriting discipline matters. In private credit, the fund manager matters more than the asset class. Private credit is not for everyone, but for the right investor, it can significantly enhance portfolio yield without taking equity-level risk. If you want to understand whether it fits in your asset allocation strategy, connect with us at Duroc Finserv. We don't chase products. We build portfolios. Thank you for watching.